private funds continue to proliferate, structured financing is playing an increasingly important role, particularly as managers look to bridge timing mismatches, optimize returns, and create greater flexibility around capital deployment. Welcome to JP Morgan's Making Sense. In this episode, we are going to explore how solutions like subscription lines, NAV lending, and increasingly sophisticated financing structures are helping clients meet their evolving liquidity and leverage needs, and how these solutions are evolving alongside the broader private markets ecosystem. I'm your host, Shaini Das, part of the Vida Portfolio Solutions product team at JP Morgan, where we focus on digital solutions supporting financing and portfolio workflows for our clients. And I'm joined today by John Neubauer. He's the Global Head of Structured Equities Financing at JP Morgan. John, thank you for joining us today.
Thank you, Shaini. Pleasure to be here.
Before we go into some of the specific financing solutions, let's zoom out a bit. Over the last few years, we have seen higher for longer rates, a slower exit environment, and much greater focus on liquidity and capital flexibility across private markets. John, what do you see as the biggest forces reshaping demand for structured financing today?
Look, I think you said it right, Shaini. I think higher rates, slower pace of exits in terms of portfolio companies held within private portfolios have really made the focus of the last few years one that's been on liquidity. As opposed to maybe prior to this, structured fund financing was probably as much or more about return enhancement. The prevailing use case now, at least on the manager or the GP side, is finding and accessing sources of liquidity, usually to support new investments and new activity, but also potentially to fund distributions. On the investor side, the liquidity need is probably a bit less acute, but it's still there because they're kind of one step removed from the pace of distributions on the manager side. So on the investor side, we continue to see investors using these tools to manage short-term working capital needs and to do things like allow for cash to be recycled to rebalance their portfolios.
Maybe let's make that more tangible by looking at some of the financing solutions in practice. So starting with subscription lines, they have been a core part of fund finance for a long time, but the conversation around them feels more nuanced now. So John, how has the market evolved over the last few years?
I mean, subscription lines have been around for a long, long time. They've been a product that's probably been used for 20 years within the fund world. The historic use case for subscription lines really was as a working capital management tool. It allowed GPs to more efficiently manage their funds by satisfying cash needs for investments and for fees without needing to call capital at each point from investors or LPs. So these lines were typically used over short time periods and then repaid. Over the last few years, the use cases really shifted a bit. Subscription lines or loans backed by investor capital commitments are being used as longer-term funding sources. Sometimes we see this with commingled funds, but we probably see it more with specialized investment vehicles, which have really proliferated over the last 3 or 4 years as well. These include continuation vehicles, separately managed accounts, or co-investment vehicles. So using subscription lines in these sort of new vehicle classes can help solve a bunch of things. It can help solve for both liquidity and target returns in a cost-efficient way. It can also be used to bridge investments with future funding rounds or future fund closings.
That's really interesting. And while subscription lines remain a core part of the market, we have also seen significant growth in NAV lending over the last few years. For listeners who may be less familiar with the space, can you explain what NAV lending is and why we are seeing increased adoption today?
Sure. So let me start with what NAV lending is. So NAV lending, or loans against the net asset value, or NAV, of a fund are effectively loans that are backed by or supported by the value of the private equity fund's equity stakes in the various portfolio companies. So it's effectively the value of the fund. And historically, funds would borrow at the very top in subscription line form based on the value of the investor's capital commitments to the fund, and or they would borrow at the very bottom at the balance sheets or on the balance sheets of the portfolio companies they invested in. But what they typically didn't do is borrow in the middle. And it's in the middle where the funds effectively have a lot of unlocked or unrealized lending value that comes in the form of the equity investments or the equity that they hold in the various portfolio companies. Now, private equity investing is an extremely competitive space, and financing has always been kind of a core part of that space. It's always been an important part of the manager's tool set. Not unlocking this value, you might say, has been a competitive miss for some managers and in some strategies. And so NAV loans and the development of NAV loans, which allowed managers to effectively borrow against this previously unlocked value in the form of the equity value in their portfolio companies, have become a critical tool. And as they become more mainstream and more cost efficient, managers have been able to use them in ways that complement both what they're doing at the subscription line level and what they're doing at the asset level. So, in a competitive space like private equity, managers need to use every tool available to stay kind of ahead of the pack. This isn't going to change. So I expect NAV loans to continue to grow and to be used more prevalently.
That makes sense, especially given how much liquidity needs and investment strategies have evolved across private markets. We're also seeing financing needs become more sophisticated as investment strategies evolve. How is that changing the way hedge funds and multi-strategy managers approach financing today?
So there are actually a lot of parallels between what's happening in the structured lending space within private equity and what's happening in hedge funds. First, many hedge funds are now raising capital in ways similar to the way private equity managers are raising capital. By that, I mean they're raising capital in the form of capital commitments rather than in vehicles that are funded on day one. So this allows hedge fund managers to access the subscription lending space in the same way private equity has. And they've really begun to use these vehicles as creatively as the private equity managers have. There are also a number of funds, particularly the larger multi-strategy shops, that are putting financing at the fund level, similar to the way PE funds use NAV financing. This financing would sit behind the shorter-term financing that they have from prime brokers or from derivative counterparties at the position level. And it can be used to better match the maturity of their investments with the financing that they have against them. And it can also be used to finance assets that typically can't be financed either in derivative form or through prime brokers. So I see a lot of parallels between what's happened in the private equity space in terms of financing innovation and what hedge funds are doing. And it makes sense because there's also a lot of crossover between what hedge funds are doing at the underlying investment level and what private equity firms are doing. So it sort of makes sense that the financing developments would mirror that.
Thank you, John. That was a very interesting perspective on how there are parallels between how the hedge funds and the private equity managers are using these financing solutions. So as these structures become more sophisticated, how do you balance flexibility for clients with a very strong risk discipline?
Yeah. So look, one of the many things structured fund financing products have in common is they try to unlock value across the fund complex, from the investor capital commitments to the NAV to credit support from entities like the GP or the management company. Underwriting and risk managing these products, therefore, requires a sort of comprehensive, complete understanding of the way each of these underlying sources of credit support function and their underlying risks, and then monitoring them through time. We've developed and are continuing to develop a suite of tools like Financing Connect, to help us track both investor bases and assets over time and across funds. This allows us to better understand where we have concentrations, both within a given fund complex and across transactions of a similar type. These tools like Financing Connect also allow clients to, in addition to providing us information that we can ultimately aggregate and use to risk manage, they allow clients to execute transactions and in a much more real-time way, track the progress of those transactions, whether it's a drawdown against a credit line, a repayment of a credit line, or compliance with the various covenants and sort of borrowing-based metrics that we have within these transactions.
That's interesting because increasingly clients expect not just financing itself, but also ongoing transparency and access to information around those facilities. It becomes much more of an ongoing portfolio management experience for the client, as you said, John, rather than simply a transaction. So looking ahead, what areas of structured financing do you think are likely to evolve most over the next few years?
Look, I think we're likely to see a greater acceptance of fund level structures and a greater fungibility across what were fund level structured financing transactions and the more traditional asset level financing that managers have always used. I think the world kind of thinks of those slightly as two different things. But as these fund level financings, whether they be NAV financings or they be hybrid financings or subscription loans, as they get more generally used, more accepted, and more cost efficient, managers will develop more comprehensive strategies for managing their borrowings and their financings across all of the various levels, whether it's the subscription line at the top, the NAV loan in the middle or the balance sheet portfolio company financings at the bottom. And they'll use them to complement one another, and they use them to sort of optimize their outcome for investors.
And if you had to pick one market signal that tells you where the space is heading, whether that's exits, liquidity conditions, lender appetite, or secondary activity, what would you watch most closely?
So I think the biggest indicator of the development, the evolution of these products is just going to be the growth of the space overall. I think these products are now part of the toolkit. They've proven themselves to be valuable and effective, not only in the market we're in, which is one that's sort of prioritizing liquidity, maybe over return enhancement, but the use case will extend across, I think, all market cycles. So I think the biggest determinant of how these things grow is just going to be the overall wallet size or the overall market size of private equity and private funds in general. And based on the last 15 to 20 years, I don't see that retreating. I see it continuing to grow. So, I think this is a space that probably has become somewhat mainstream, but certainly will be more mainstream going forward.
John, really appreciate you taking the time to speak with us today. It's been fascinating hearing how the financing solutions are evolving alongside the broader private markets ecosystem and how flexibility, liquidity, and transparency are becoming increasingly important across the market. For those who are interested in learning more about Financing Connect, please see the link in the description below. And thank you again for joining us. And thank you to our listeners for tuning in.
Thank you, Shani.
Thanks for listening to JP Morgan's Making Sense. If you've enjoyed this conversation, share your feedback by leaving a comment or review wherever you listen to podcasts. And be sure to follow our channel so you don't miss an episode. This communication is provided for information purposes only. Please visit www.jpmorgan.com/disclosures for important disclosures. Copyright 2026 JP Morgan Chase & Co. All rights reserved.